We are seeing that's becoming more and more common for retirees to take on these small self-employment gigs in the retirement years. Some are doing it just to stay mentally active and engaged. Some are doing it just because they really like what they did during their working years and just decided to kind of cut back some. And some are doing it for just some additional extra income. But it shouldn't be overlooked that having this self-employment income in the retirement years can present tremendous wealth building opportunities. And there's a number of strategies that we enact for clients. But one of the main ones is the use of a solo K plan. Not because you're trying to save additional income for retirement because you're already retired, but I'm going to go through why it's a great wealth building and tax strategy. First, let me explain what a solo K plan is. So a lot of people are familiar with 401k from their working years. This is the same thing, but it's a 401k for owner-only entities. So sole proprietors, partnerships with just partners but no full-time employees. So it greatly simplifies it. The costs are dramatically lower for sponsoring these types of plans. There isn't a lot of administrative hassle associated with them, very easy to use and operate, but it gives the business owner the same contribution limits that were available in the full-fledged 401k world, which is what makes them so valuable from a wealth accumulation standpoint. Solo K plans have two main contribution sources. They have employee deferrals and they have employer contributions. Now, since you're both the employee and the employer, you actually have access to both. But let's start off talking about the employee deferral piece. So that employee deferral piece for 2023, the maximum contribution you can make is the lesser of 100% of your comp, or if you're age 50 or older, $30,000. So the way this works is if I make, let's say, $20,000 net from my entity, I can put a full $20,000 into my solo K plan. If I make, let's say, $100,000, then I'm limited to that $30,000 max employee deferral contribution. These employee deferrals, you have a choice to make. Do you want to make pre-tax deferrals or do you want to make Roth deferrals? The pre-tax deferrals are the ones you take a tax deduction for now and you pay tax on all of it later on. The Roth deferrals are the ones where you don't take a tax deduction, you pay tax on the money, but then all the accumulation when you withdraw it out in the future is tax-free. The only requirement to receive those Roth earnings tax-free is you have to be over the age of 59 and a half at the time of withdrawal, and that account has to have been established for at least 5 years. Where we see this wealth building strategy work is really within this Roth source. You have someone who's able to put in $10, $20, $30,000 a year in Roth. They build up this Roth balance in their solo K plan to $100,000, $150,000, and then they're able to accumulate those assets for another 5, 10, 20 years, and all those earnings are received tax-free. Roth Solo K also does not have many of the limitations of actually making Roth IRA contributions. So for 2023, if you're age 50 or older, the max contribution to a Roth IRA is only $7,500, where a Roth Solo K gives you access to that $30,000 limit if you have the income from your self-employment to back that up. Also, Roth IRAs have those income thresholds where if you earn over a certain limit, you can't contribute to a Roth IRA anyways. Roth Solo K does not have income thresholds. Regardless of how much you make, you can make those contributions to your Roth Solo K. Outside of just tax-free accumulation, which is excellent in itself, there are other benefits to building up these Roth balances within your Solo K. Like if you stop your self-employment income and then you roll over that Roth Solo K into your Roth IRA, Roth IRAs are not subject to required minimum distributions, RMDs. Your traditional IRAs, your pre-tax 401k accounts at 72, they're going to force you to start taking money out and paying tax on some of those distributions. RMDs do not apply to Roth IRAs, so you can keep accumulating. In addition, when we look at a client's total asset picture and what they may leave for the next generation, Roth is sometimes the most valuable asset that someone can inherit, because even though they changed the inherited IRA rules, so non-spouse beneficiaries now have to empty retirement accounts within a 10-year period. So if it's a pre-tax account, they have to realize all that income in a short period of time. Roth accounts have that same distribution requirement. However, there's no tax to the beneficiaries. And essentially, a beneficiary can inherit a Roth account, accumulate that for another 10 years. And when they take it out in year 10, they pay no tax on any of it. So it's a super valuable asset. It's not uncommon for a lot of business owners to have never made a Roth contribution because during their working years, maybe when they're a W-2 employee, they were always in a higher bracket, so it warranted doing pre-tax deferrals, taking the income off the table and then realizing it in retirement. But now that they're in this lower bracket and they're saying, hey, my tax bracket's never going to be higher than it is now, like pre-tax benefits tend to lose their potency, and sometimes it makes sense to do those Roth. But there are scenarios where you can use the pre-tax portion. We've seen some where one spouse is still working full-time and the other spouse retires and does some stuff on the side with some self-employment. They do a solo K plan, but now they want to do pre-tax deferrals because their income is still relatively high. They can do that. You have the option from year to year. Do you want to do pre-tax? Do you want to do Roth? Do you want to do some combination of the two? So these are very flexible plans. One of the common questions I'll receive is, Mike, what's the difference between a solo K plan and a SEP IRA? A lot of people have heard of SEP IRAs because they're popular retirement plans for self-employed individuals. Now, the main difference is the contribution limit. So with SEP IRAs, there's no Roth option. So number one, no Roth feature, but SEP IRAs, the max contribution amount you can make is 20% of your net earned income. So if you make $20,000 for the year, the most you can put into a SEP IRA is $4,000. Well, remember with a solo K plan, that's got that deferral piece, which you can contribute 100% of your comp up to, if you're 50 or older, $30,000. So SEP IRA, 20,000 net, I can only put in $4,000. 20,000 net in a solo K, I can actually put in all $20,000. So it's way more powerful. Plus the solo K plan, you get the deferral amount, but if you have income over and above that, they also allow you on top of the deferral, the 20% of net earned income for a profit sharing contribution. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.